Welcome to the Generational Wealth Podcast. The Fed just raised interest rates for the eighth straight time. In today's show, I'm going to show you what that means for your wallet and what steps you need to take to get prepared. All I need you to do is smash that like button. That goes a really long way towards supporting this channel. So guys, welcome. Happy Friday. I want to give a big shout out to everybody that's on. Please leave a comment below. Let me know that you're here. Shout out to videos, to views. Thank you for all of the support. Today, I'm going to break it down. How does the Federal Reserve impact you? All of us are going to take an impact from this change. I need to make sure that y'all know what's coming. I want to give a big shout out to everyone who signed up for their free session on insuring your way to wealth, how the rich use insurance to build and protect a fortune. Guys, if you haven't done this yet, I don't know what you're doing. It's a free 1-hour private call with me where I'm giving you a consultation about how the wealthy use insurance to increase their estate. I'm giving you guys little known secrets that rich people do to increase their generational wealth. Y'all need to check that out. All you got to do is click the link right now to sign up. It is a free session. You've got nothing to lose. If you're ready to take control of your financial future, make sure that you click the link in the comments below. For my folks that watch this podcast after the live stream is over, I got to look out for y'all also. We're now starting to put them in the description. Okay. So make sure that you guys check out this content. You don't want to miss out. And I also want to give a big shout out to our sponsors. Now, there's those of y'all that give sponsorship after the show, like Paige, and I definitely want to make sure that she's acknowledged. Shout out to you. Thank you so much for all of the support. A sponsor is someone that keeps this channel going. As you know, I am constantly putting in a lot of time and energy to give you guys high value content. And I cannot do this without your support. So please, if you guys get a lot of value from tonight's show, do me a favor and give that Cash App. Do me a favor and give that super chat. All you got to do is tap the dollar icon and look at me. I'm messing up. I'm talking about tonight's show. The Friday shows are a little bit earlier. I'm so busy being used to doing the shows on Monday and Wednesday at night. The Friday shows, this is for the day. This is so that way y'all still got some energy before y'all get into the weekend. We're going to end the week on this note right here. The Federal Reserve just raised their interest rates. I'm giving y'all the game about what you need to do to stay protected. Okay, so let's go ahead and get to the show, y'all. For those of y'all that want to donate, please make sure that you tap that dollar icon directly below. Your super chat goes a long way. Whoever makes the highest donation will be the official sponsor of the podcast. And for those that want to donate through Cash App, $ Gen Wealth Podcast, the information is on the screen. Let's talk about the show. The Federal Reserve just raised interest rates for the 8th straight time. It's getting crazy. The reason why they're raising the interest rates is because they're trying to curb inflation. Now, if you've been on this podcast, you should already know what these terms mean. For those of you all that are new, inflation is everything going up in price. The cost of everything is going through the roof. Gas prices are back on the rise. Eggs are just ridiculous. You feel like you're eating at a gourmet restaurant just paying for the price of eggs. Everything is becoming more expensive. So if everything is getting pricier, that means we're losing a lot of purchasing power. So what the Federal Reserve is trying to do is they're trying to lower prices. They're trying to get spending to slow down so that way they can get the economy in control. At their latest meeting, the central bank approved a 0.25% increase in interest rates. For those of you that might hear this on the news, they'll call it 25 basis points. Now, for those of y'all that have been wondering, is inflation slowing down? Yes, inflation is coming down, but there's still a very long way to go. And there's still a lot that the Fed is talking about doing to get the economy back to where it needs to be. Guys, I need to make sure y'all are tapped in on this, because if you don't know what the Fed is doing right now, you won't know how that's going to impact your finances. I'm going to share some secrets about how the Federal Reserve manipulates how many people win with money. And I'm going to share with you a secret. Right now, there are a lot of people that are winning, and some of that is going to stop after this market goes where the Fed wants it to go. I need y'all to tap in. If you're making money right now, I need you tapped in, so that way you can keep doing it after the Fed does what it wants. If you're not making money right now, I'm going to show you how you can recover. I need y'all to see where the economy is going. If you're trying to create generational wealth, you have to understand the economy. And that's why I'm breaking these terms down in a way that you can understand. The Federal Reserve raised the interest rates to try to cool down the economy. Things are getting too expensive, and now they're trying to make things more affordable. So the Federal Reserve has raised the interest rates, but it's going to take some time before their actions impact the economy. I don't know how many of you guys saw a recent show that I did where somebody was claiming that the recession was already over. And I was explaining to that person that just because the Federal Reserve does things right now, it takes time before the average person feels it in the market. Like, there are a lot of y'all that are saying, wait, what you talking about? Inflation is slowing down. I feel like things are getting more expensive. Why is that? Because from the time that the Fed takes action, it takes a while before you notice a difference. We are still living off of the years of events that led up to this. I have been telling y'all about how whenever those stimulus checks came out a few years ago, after you know what happened, the economy was artificially inflated. What that meant was there was so much money that was printed by the government that spending got out of control. That's the reason why inflation is so high today. So what the Federal Reserve is saying is we got to now tone that down. Things are getting way too expensive. It's becoming very hard for the average person to get by. A lot of people have run through their savings accounts and they're going into debt because they don't have the money to cover the cost of inflation. And so the Federal Reserve Chairman, Jerome Powell, made a statement earlier this week saying that he expects that there's still going to be a couple more interest rates hiked up. So don't think, oh, they're going to stop it right here. This is going to be the eighth one. It's all done. The economy is good now. No. The Federal Reserve, they're still on their war path to stop inflation. He also said he doesn't see them cutting interest rates this year. Now, guys, you might be wondering, what are these interest rates, Uzziah, and why should I care? The reason why you care is because you were going out buying houses when the interest rates were brought to zero. Remember that? Remember the time where the Federal Reserve cut all the interest rates when the Rona popped out? And then when the Rona happened, they decided, hey, to make sure that things would be really easy on the people economically, we're going to bring the interest rates down to zero so that way it relieves financial pressure. When that happened, it made debt so much easier for the average person to get. People bought new homes, people bought new cars, people got credit cards. But as inflation goes up, the cost of everything is more expensive. As interest rates go up, it becomes harder to hold on to debt. So if you want to know why these interest rates matter, it has everything to do about the purchases that you make and how much harder things are going to be if you're stuck in debt. I want to show you how you can avoid that on today's podcast. I also want to show you how you can capitalize on what's happening right now in the economy. Because I'm going to tell y'all, it's not all doom and gloom. You just have to know how to play this game so that you can capitalize on the market. Let me check out these comments. Jack was saying, what happened right now? Ariel said, inflation is crazy. I still can't believe the cost of eggs. Jack says, I'm in auto sales. It's crazy watching the value reset, the book values reset. Thank you for clarifying that. I was trying to translate. Make sure that y'all smash that like button, y'all. And if y'all are just popping in, today we're talking about how the Fed just raised interest rates and how that's going to impact you and your family. As Jack stated, rates affect everything. A lot of y'all get duped because y'all think this is just something on Wall Street. You don't see how these interest rates affects every person. Guys, we all have money in the market, some more than others, but we can all agree that our buying power has been diminished. Why? Because the cost of everything has gone up. Before, nobody was paying attention to the price of eggs like that. Now, everybody is talking about it. You got six-figure earners, people making multiple six figures, talking about how expensive eggs is, how much it costs to get gas. Everybody is getting hit with inflation in their own way. And so I want y'all to understand what the Federal Reserve is doing here. Right now, the current inflation rate is 6.5%. That's high. What the Federal Reserve wants is to bring the inflation rate down to 2%. They've still got a long way to go. And I know y'all are saying, well, wow, if they're trying to bring the inflation rate down from 6.5% to 2%, then why are they only raising the interest rates to cool down inflation by 1/4 percentage point? The reason why they're doing it slower is because they don't want to crash the market. They know if they go too hard, too fast, a lot of people are going to suffer. Guys, I'm going to show you on this podcast what happens whenever the Federal Reserve raises interest rates. You might not realize it, but this has everything to do with your livelihood, your job, and your potential for creating generational wealth. I want you guys to see how this is going to affect you for the year to come. So again, the Federal Reserve is trying to bring the economy back to 2% inflation. They've still got a long way to go. That's the reason why Jerome Powell says he doesn't see them cutting any of the interest rates for this year. The interest rates affect how you can buy a home. The interest rates affect what type of interest you're going to have on your credit cards. The reason why the Federal Reserve wants inflation to be around 2% is because they need a balance between keeping the prices stable and helping the economy grow. Y'all got to see it. If prices go up too much, money won't go as far. But if prices don't go up enough, it's going to be hard for the economy to grow. That's why the Federal Reserve, they want to manage inflation. They don't want it to go away completely, but they want it to be a lot lower than where it is right now. Because inflation is so high, it's hard for the average person to make it. And I'm sure y'all feel the effects. I want y'all to leave me a comment right now and let me know how your lifestyle has been impacted because of inflation. Some of y'all don't know this, but your cost of living, you've had to pay thousands more just to maintain the same cost of living that you had from a year ago. That's how expensive things have gotten. The reason why the Fed wants to manage inflation is because if inflation goes through the roof unmanaged, your dollar doesn't mean nothing. If the prices don't go up and there's no inflation, it's going to be hard for the economy to make progress. See, when you're an investor, you want the economy to grow. If you're a consumer, you want the economy to grow. You want businesses to grow so that way they can give you the products that you want and they can provide jobs. You want the economy to grow so that way you can continue to make money. If the economy doesn't grow, then we'll go into a recession. And when we go into recession, that's when people take L's. That's what we're talking about on this podcast. With the current inflation being at 6.5%, it means that things are getting very expensive very fast. This is very hard for people that have to buy food and clothes because everything costs more money. It's also a problem for businesses. The reason why it's a problem for businesses is because it costs them more money for production. If they have to manufacture something, it's going to cost more money for them to manufacture it. I'm sure you've seen prices go up at Walmart, Target, and Amazon. That's the reason. So when prices go up, it becomes harder for people to save their money. It's going to everybody else. And your money doesn't stretch like it used to. See, if you're living in really expensive cities right now, you're getting hit hard. If you're living in Los Angeles, Miami, New York, you already know what time it is. You could already do this podcast for me. Your money means nothing. And you try so hard to be able to afford a living, but it seems like the more you make, the more prices go up. This is the problem. The market is growing faster than wages. College education is outpacing wages. The housing market is outpacing wages. If everything that you want out of life is outpacing how much money you'll make, then how will you ever be able to afford something? That's why we're talking about this, guys. All right. So when we talk about this high inflation, sometimes it's a good thing. The reason why I say it's sometimes a good thing is because it's a sign that the economy could be doing well, right? If everybody is out here spending money, then that means that the masses of people are in a good place. But that's not always the case, especially in a situation like this, where we're now doing cleanup from the trillions of dollars that was printed in this country a few years ago. A lot of people got fake money. What do I mean when I say fake money? For those of y'all that don't know, you should already realize that a dollar is fake. The reason why I say that a dollar is fake is because it's not backed behind anything. It's a fiat currency. At one point in time, before a lot of us were born, the dollar was backed behind the gold standard. It was tied to gold. But now your dollar is just a piece of paper. All the government has to do is hit one button and it could print out trillions of dollars. And when they print out these trillions of dollars, the value of every $1 plummets. That's what happened. When the stimulus checks came out, the value of the dollar plummeted drastically. And everybody started spending all of this money. And now you got to make so much just to keep food on the table. So, what the Federal Reserve is trying to do is they're trying to figure this out, but they have to be slow and steady with it because they cannot move so aggressively that it destroys the market. The market is very delicate, y'all. There's a lot of people right now that are living paycheck to paycheck. So if 70% of Americans are living paycheck to paycheck right now, going into record levels of credit card debt, the Federal Reserve understands if they go too hard, a lot of people are going to be on the street. If a lot of people are on the street, a lot of people are going to commit crimes. If a lot of people commit crimes, then we've got a problem. So that's what this whole thing is about in a nutshell. But now we're going to unpack it to show you what it means for you and your accounts. So the Federal Reserve is still looking to raise interest rates. Be on the lookout for more interest rate hikes to come. Also, a lot of investors are trying to see what the Federal Reserve is going to do because they know that when the Federal Reserve plays with the interest rates, it could have benefits to the stock market. So the Federal Reserve is not saying anything about stopping raising interest rates. Why? Because if they said that they were going to stop raising interest rates or they want to begin to start cutting interest rates and cooling things down, that could actually put the economy into a recession. There's so many stock prices that hang on the words of the Federal Reserve's chairman. If Jerome Powell gets on camera and says, hey, we've got to really control this market, the investors are going to take his words and they're going to make certain moves off of it. So he cannot say that he's going to cut interest rates, even if he plans on doing it later this year. But when the Federal Reserve raises their interest rates, here's what happens to the economy. One of the things that typically happens when the Federal Reserve raises the interest rates is that the cost of borrowing money goes up. It becomes more expensive for consumers and businesses to borrow money. A lot of people use debt. And we're talking about personal loans, business loans, car loans, the list goes on. If borrowing becomes more expensive, there's less people that are looking to spend. In some cases, it's less people that are looking to invest their money. Everything is so expensive. So what money do you have to invest? That can dampen the economic growth of the market. Something else that can happen when the Fed raises the interest rates is that it creates a stronger currency. Remember what I just told you guys. When the government prints a lot of money, the dollar gets weaker because there's more supply. So when the Federal Reserve now raises the interest rates, it actually tightens the market, so the value of every dollar matters more. Now, for those of y'all that watch the news, you might not realize how much raising interest rates helps with foreign affairs because it tells other countries that the US dollar is stronger. That affects a lot of trade. So these are the types of things that you just want to be able to know about. It's something that'll make you sound good and smart whenever you're out with somebody and you need to, make a good impression, make yourself look like a high value man. These are the types of things that you really want to be able to understand. And you never know how it could affect you in your day-to-day life. Let me check the comments. Okay. We still talking about eggs in the comments, I see. Ariel said that egg allergy is definitely a blessing in disguise. She said that because Jack said, luckily my wife is allergic to eggs, so we don't keep them in our house like that. Absolutely, man. The cost of eggs are going up. And for those of y'all that don't see what's happening, everything is getting very expensive because inflation affects the economy. We have not felt all of the effects of everything that's happening to the market. And that's the reason why I'm reporting on this as it happens. So that way, before it actually comes to the economy, you can be prepared. There's a window of time. You got a head start when you watch this channel to know what's coming down the pike and make adjustments. Jack says, in my line of work, people and business owners are scared to pull the trigger due to inflation. Business owners are more willing because of tax breaks, but regular consumers are terrified. He said, small town Indiana has been lucky so far. I hope it doesn't get too bad. We'll see. Let's check this out. One of the things that happens whenever the Fed raises interest rates is it lowers inflation. Because borrowing becomes more expensive, higher interest rates slows down the economy. When the economy slows down, inflation slows down. This is one of the main reasons that the Fed raises the interest rates in the first place. So right now, it's just a guessing game. I want y'all to realize when you look at the Federal Reserve, they don't have a 100% accuracy over how to manage the market. They are experimenting with everybody's life, and that's scary. Right now, they're playing one big guessing game. Okay, if we raise the interest rates like this, how will the people be affected? Is it going to slow things down? Let's just sit back and watch. The Federal Reserve has no way of knowing exactly what's going to happen within the market. So they make all of these adjustments month by month where they're just testing the outcomes. It's like a scientific experiment. And what we got to see is sometimes the Federal Reserve has done this in the past during our parents' day, and that caused a lot of problems. So they're trying to just get a feel of what would be best for the economy. It lowers inflation, but it can also reduce stock market performance. I don't know how many of you guys are looking into being stock investors, like I always talk about on this channel. But when the Federal Reserve raises interest rates, higher interest rates leads to lower profits for companies. Why? Because not as many consumers are spending money. I'm trying to break this down, y'all, so it's so easy a 5-year-old can get it. I don't want y'all to cut on CNBC and you like, man, they speaking way over my head. I don't understand none of this money stuff. That's the reason they trying to keep me broke. That's the reason why I'm stuck in the middle class. I want you to work your way out. But if you don't make an investment in yourself to know the economy, then how will you ever understand generational wealth? Money is a language. And if you don't speak the language, it's going to be hard to be good with making money. That's why I share this with you. So for those of y'all that are getting a lot of value and you're learning a lot from this podcast, please do me a quick favor. Please find it in your heart to tap that dollar icon directly below to keep the channel going. Your donations go a very long way to allowing me to reinvest into this show. As you guys know, I'm always doing a lot to make this show bigger and better. I try to give as much value to you guys as I possibly can. Now, higher interest rates means lower profits for companies. Americans are not spending money during recessions. And investors, because of which, get a lower return. That means that stock prices can fall. That's the reason why a lot of stock investors, they don't think that the market has hit a rock bottom yet. Even though the stock market went under last year, they still don't think it's at rock bottom because a lot can still happen with the Federal Reserve. A lot can still happen in the economy. Now, the last major thing that raising interest rates does is it encourages saving. This is where you come in. When interest rates go up, it makes it more attractive for consumers to save. Why? Because it's harder to spend. If a recession is going on, you don't want to be out here spending all that you have. You want to start saving for a rainy day. This can help you get out of debt and improve your money situation overall. The economy might take a hit, but you as a person can level up. That's why I want to do this show. I want to show you how you can capitalize off of this eighth interest rate hike by making sure that you outperform what the average person is going to suffer in this market. I hate to break it to y'all, average person is going to suffer because they don't take the time to see what's coming. I'm giving a warning. I'm telling people about the train wreck coming, but they still want to stand on the tracks. Those of y'all that are watching, y'all are listening, y'all are getting off of the rails, and y'all are going to be the ones to walk away on top, hopefully, as long as you apply the things from this show. Now, overall, guys, the market seems pretty good because the unemployment rate is at its lowest since 1969. Can you believe that? As much as everybody talks, doomsday, it's here. As much as everybody wants to make you think that the sky is falling down, this is the lowest unemployment rate that America has had since 1969. That's a gift and a curse. Y'all know the reason why that's a gift and a curse? It sounds like only a gift, right? Hey, the more people are getting employed, the more people are able to win. The reason why it's a curse is because I got a secret for you. America wasn't built for everybody to win. In capitalism, you have the haves and the have-nots. What the Federal Reserve is trying to show you is that too many people are winning in this economy. Somebody's going to have to take a L. When you look at what's happening right now, inflation is at 6.5%. Everybody's spending money. Some people are on the receiving end of the money that's being spent. The Fed says, no. We got to slow this down. Too much money being spent is going to mess up the consumers long term. We've got to slow this down before it becomes a bigger problem. And when the economy slows down, who's going to take the hit? The middle class. The rich won't take the hit because they've got enough money to weather the storm. The poor won't take the biggest hit because they're already being supported by the government. The number one class of people in America that will be impacted by what's happening right now is the middle class who's being pushed out of the market. You're either going to be a part of the haves or the have-nots. My job is to help as many of you guys become the haves as possible. Don't take this serious. Don't make changes. The economy is engineered to make sure that you're at the bottom. That's what these interest rate hikes are all about. Inflation is at 6.5%. They want to bring it down to 2. With unemployment being at the rate that it's at right now, it's a sign that too many people are winning, and the Federal Reserve can afford to take more action. Just in case you don't know, when the Federal Reserve raises interest rates, that can then make businesses do layoffs. That's the reason why y'all have been hearing news about companies in tech laying off thousands of employees, tens of thousands. Google laying off employees, Microsoft laying off employees. Why is this happening? Because whenever spending slows down in the market, that gives businesses less money to pay people. If businesses have less money, then you as the worker have less money. That's the reason why I always preach the importance of having multiple streams of income. If you happen to lose your job this year, God forbid, I want to make sure that you have a safety net. That's why I'm always talking about an emergency fund. That's why I'm always talking about you having multiple streams, including business, so that you can make money on your own. The average millionaire has 7 different streams of income. Why do you think the average millionaire has 7 different streams of income? Have you ever thought about that? It's not just because they want to maximize all of this money from all these different places. It's because they understand that any one stream of income could collapse during a recession. So if their business takes a hit, now they're going to make money in real estate. If real estate takes a hit, now they're looking to make money from the stock market. You've got to know this game. Otherwise, if you only have one stream, which is your 9 to 5, if the Federal Reserve keeps raising interest rates, you could be the number one target. When recessions happen, employees take the hit because businesses have to cut back their spending and they're going to reduce their payroll to make that happen. Let me see if we got any more comments in the house. Videos to Views said, enjoying this live stream. Great value. Thanks, Uzziah. Thank you so much, Videos to Views. All right. Thank you so much. And I appreciate your patience and sticking around. I'm telling you, my Friday shows are always the hardest to get started because I'm making so many preparations for the weekend, but I want to make sure that y'all don't miss out. Ariel said, dang, that's a heavy point. America wasn't built for everybody to win. It wasn't. At what point did everybody win in America? Let's not talk about how America got started. We don't even want to go down that path. My people, we didn't come here winning. We were used to make other people rich. And a lot of the system behind the American economy is still in place. Maybe not through chattel slavery, but a lot of us are told to only make money by working at a job, and then we become a wage slave. We don't think about how we can actually do some of this on our own. We don't think about, man, there's so many opportunities right now for us to make money outside of our job. I'm not telling you guys to quit your job. I'm saying start to work on your next stream. If the average millionaire has 7 different streams of income, and I want y'all to think about this, guys. There's a lot of y'all that hear that and you say, oh man, I'm going to start 7 new streams right now. Don't do that. This happens over time. So you want to focus on mastering one thing, and then over time, you can take the money from that stream and you could use it for other accounts. Let me give you guys a prime example. When I first started working in corporate America, I only had one stream of income, my 9 to 5 job. I took the money that I made from corporate America and I put it into investing into real estate. When I invested into real estate, that was my second stream of income, but it also provided me with added protection to be able to quit my job because now I had money coming in outside of the 9 to 5. I then took the money that I was making from my 9 to 5 and real estate and used that towards starting a business. I used that for business capital. And this is how millionaires do this, guys. Okay. This is the reason why I always show you how I go about making money. I can make money from my business, I can make money from real estate. I can make money in different ways because it's about starting off with one skill set and then using the money from those skills in other places. And one of those streams is in the stock market. And right now, the stock market has been good to me, guys. I want y'all in on it. And so this is just how you can make the right moves. America wasn't built for everybody to win. I'm not being racial when I say that. I'm being factual about the economy. The entire thesis of capitalism is somebody wins, somebody loses, somebody outcompetes, somebody takes the L. That's how this economy is structured. That's the reason why you have a middle class. You have people that are in poverty. You have an upper class and you have the elite. You have the top 1%. This is how society works, y'all. Y'all see it. We don't even need to make this about politics, race, none of that. This is just how the world really works. This is how America runs. And so what America is saying is there's too many people that came up over the past few years. We got to level this out to stabilize the economy. I want you to think about some examples of how too many people won over the past few years. How often do you see guys talking about how they became an instant millionaire overnight through cryptocurrency? Look at how many people took a hit. Look at how many stories you read about guys who offed themselves because crypto millionaire today, bankrupt tomorrow. You've seen entire crypto companies go bankrupt. Why? Because the market inflated too fast. And this is the reason why success is a long game, guys. Whenever you see people talking about, oh man, you could get rich overnight, all you got to do is click a button, you always want to take caution. When you look at the world's wealthiest people, they got there over a long term. Warren Buffett, he's almost 100 years old. He got there over a long term. It didn't happen overnight. And so right now, there are a lot of people that made money, stimulus checks, crypto. It was a lot of folks, PPP loans. Folks had PPP scams going. It was a lot of people that came up falsely. So what the economy is doing is it's regulating everything out. This is a part of an economic season. No different than how in the winter there's a pruning process before spring brings new growth. Do y'all feel me? So the unemployment rate is as lowest that it's ever been since the 1960s. But we got to watch that because when the Federal Reserve sees that, they see opportunity to continue to raise the interest rates. Let's talk about how higher interest rates affects your money. First off, if you have credit cards, Higher interest rates means higher APR. The average credit card rate right now is 20%. That's high as hell. Because credit cards are tied to variable rates, meaning that it fluctuates based on the market, it means that when the Fed plays with the interest rates, all of your credit card interest rates go up. If you've got credit card debt, that's not a good thing because it makes it that much harder to get out. Guys, I want to tell y'all something. If you have credit card debt right now at more than 19% interest, if you have the average credit card balance, which is $5,474, it would take you almost 17 years to pay that off if you made the minimum payment. Did you hear what I just said? Right now, the average credit card balance is $5,474. Don't sound like a lot of money, right? But it's enough to rack up some debt. If you have the average credit card balance in America, if all you do is pay the monthly minimum that the credit cards tell you, it would take you almost 17 years to pay off the debt. The reason why is because of high interest. You would be paying more than $7,000 in interest. Did you just hear what I said? You had a $5,000 balance. The interest that you're going to pay over the long run is more than the balance that you started with. This is how you stay broke. This is how society keeps people at the bottom. Because they know you want to spend money. They know that you want to have the nicest clothes so you could be on social media flexing. So they say, yeah, go and get this credit card right here. Don't worry. And then you start to make one payment turns into two. You don't even think that you're spending that much money, but it starts going up. And then slowly over time, the market goes down. And then when the market goes down, guess whose money gets affected? That's your money. And you probably got into this credit card debt on silly expenses. iPhone, eating out, buying Jordans, whatever your vice is. This can put you in a lifetime of debt. Y'all, if you don't know how to manage a credit card, you ain't got no business using it. A credit card is like having a loaded gun. It can help to save your life and protect you, but it could also be very dangerous in the wrong hands. And you don't want to use it against yourself. I can only show you the way, y'all. You could lead a horse to water, but you can't make him drink. I'm trying to give him the game videos to views, but they got to do something with it, man. I don't know what else to tell y'all. When the interest rates go up, that's when credit card holders take a hit massively, because the average interest rate on a credit card right now is 20%. Credit cards, for the most part, are variable. So when the interest rates go up, so does your debt. This is the time I need y'all laser focused on getting out of debt. I need y'all laser focused on this, man. Because y'all look at this and say, Uzziah, my credit card interest rates ain't going up. No, it's not going up right now because the announcement was made earlier this week. A lot of y'all don't realize it takes at least 1 to 2 billing cycles before these changes take effect. That's why every time something happens in the market, y'all need to be coming on this show, figuring out what's happening, so that way you can get prepared. You can take a head start. So that way, by the time it penetrates the market and the average person gets hit, you're already in the clear. Right now, what you need to be doing is getting out of credit card debt. If you got multiple kinds of debt, credit card debt is the number one kind of debt that you need to get out of right now. It's Mayday. Credit card annual percentage rates are up from 16.3% last year. Right now, it's almost 20%. Just a year ago, it was at 16%. It's going up very fast, guys. And you got to make sure that you're prepared. The second thing that you want to be on the lookout for is mortgage rates. Mortgage rates go higher. When the Fed raises the interest rates, that's when the mortgage rates go up. So for all of y'all thinking about buying a house, you need to be on the lookout. Now, I almost got ahead of myself. I still got to show y'all something about these credit cards because y'all think I'm playing. Y'all don't realize this credit card crisis is real. It's realer than real. Look at this. Credit card balances in the U.S. are well above pre-pandemic levels. Monthly totals of all credit card and other revolving loans at U.S. commercial banks. I want y'all to look at this, y'all. I'm going to zoom in. This shows this is how much debt people had back in 2019. 800 billion. Here we are now, 2023. We're headed towards $1 trillion. Do y'all see how much that line jumped up? I need y'all to just look at that for a moment. Do you see what happened from 2020 going into 2022? Everybody was paying off their credit cards because they were getting stimulus money. But do you know what happened? When everybody started spending money, that's when businesses went up in prices. When businesses went up and gas prices went up, guess what else went up? Debt. Because all the money that you had in your savings, it couldn't keep up with inflation. And then you cleared your savings account out because you were spending beyond your means because life has gotten so expensive now that now you're having to take out credit cards just to maintain a living. That's what this line going to the moon is all about. This has been the economy, y'all, for the past 12 months. Just want y'all to think 2023 just started. So when we're talking about this line is just starting. It's not showing the line going down, guys. It's going up. Look how high this line is going. This is going to create a crisis. You hear about all these bubbles: housing bubble, student loan bubble, credit card bubble. A lot of people are going to get hit. So guys, I encourage you, if you don't do nothing else in 2023, please make sure that you pay off your credit cards, because if you don't, it's coming for you. You better kill off that credit card before that credit card kill you. That's the only thing I can say. Now let's talk about mortgage rates. Mortgage rates will stay higher. The average interest rate for a 30-year fixed rate mortgage is around 6.4%. Just a year ago, the average mortgage rate was 3%. Do y'all see what's happening? Now, I know it's easy to miss this when you're out there living everyday life. But if you're not careful, you're going to look up one day and it's going to be too late for you. The market will have shifted completely. a lot of the things that you will have wanted to accomplish will be totally out of reach. And that's the reason why you got to stay ready so you don't have to get ready. That's the reason why you got to stay on the lookout for what's coming. Right now, with the current price of homes, average home being $400,000, you take a $400,000 home and you add that on top of a 6.4% interest, it's very hard for the average person to afford a home. Remember, when they sold the American dream, it was about everybody having a nice home with a white picket fence. I keep trying to tell you, this is about the haves and the have-nots. If you don't pay attention to how to win at this game, there's a good chance that you may never be able to qualify for some of these different land purchases that are out on the market, guys. If you don't understand generational wealth, it's going to be very hard to do things like invest in real estate, much less have a dream home. The average home is $400,000, and that's out of reach for most Americans. So, with high interest rates and high home prices, it makes it very challenging for most people. This is the reason why you started to see there be such a crisis in the housing market. You start to see not as many people are buying homes right now, and that's for a reason. Okay, so the interest rate hike, it's increasing the cost of new mortgages. When you think about how the Federal Reserve is increasing these interest rates, you must consider every time interest rates go up, that's more money being added to a 30-year loan. I want you to think about this, guys. If mortgages increase by 0.1%, that's an extra $10,000 over the lifetime of a 30-year loan for the average mortgage of $400,000 for all new homes in America. If interest rates increase mortgages by 0.1%, by 10 basis points, that means there's going to be an extra $10,000 bill to you who wants to buy a home on a 30-year loan, when the average loan for a home is $400,000. Okay, so let me just be clear on this. I don't want to mess y'all up with the numbers. A basis point is equal to 0.01% of a percentage point. All right, just so that way we have the numbers. I know a lot of y'all hear basis points, a lot of y'all hear interest rates. You're like, what the hell is that? Just make it make sense. I just need y'all to know higher interest rates, higher mortgage. So these are all things that you need to understand. There's still a long way to go before the housing market is affordable for most Americans. And not only that, a lot of people have been getting new mortgages. They've been getting adjustable rate mortgages, and a lot of people have been getting HELOCs, home equity line of credit. If you've got all of these HELOCs and adjustable rate mortgages, then all of these interest rate adjustments are affecting you. Guys, we're going to move on to the next topic. Auto loans are getting more expensive. Okay, we already talked about credit cards. This is for your everyday purchases. We already talked about buying a home. Now we're going to talk about buying a car. Auto loans will get more expensive. Even though auto loans are fixed, you want to think about how the payments on those loans are getting more expensive because of the rise of interest rates on the loan. So if you're planning to buy a car, that means that you're going to have to spend more money in the months ahead. The average interest rate on a 5-year car loan for a new car is currently 6.18%. That's up from almost 4% last year. Guys, I want you to see everything is going up. Every time you hear me talking about all of these major purchases that people use every day, you hear it keeps going up and up and up and up. And if you're not paying attention to it, you could be the person, oh, I want to go and get a car, but you weren't studying the market. And now you're being priced out of the market on purpose. Oh, I wanted to buy a house. Now you've been priced out of the market. That's the reason why generational wealth requires financial literacy. The Bible says, my people are destroyed for a lack of knowledge. Because we lack the knowledge on how to do this, this is the reason why it seems like we can never win. If you want to win, guys, you got to know how to prepare yourself. Proper preparation prevents poor performance. And I ain't going to be on here all day neither talking about this. I'm just going to give you all the game and then I'm going to be out. If y'all are getting a lot of value from this podcast, do me a favor and tap the dollar icon directly below. Your donation goes a long way, guys. Let's get a donation started. I done been on here for I don't know how long yet. We got to get a donation going. Let's get a Cash App going. $ Gen Wealth Podcast. Whoever is the highest donor for today's show, whoever is the highest donor for today's show, because y'all know it's the Friday show, you will be the official sponsor of this podcast. And I appreciate y'all so much for the support. I'm trying to look out for y'all. I pray that y'all do the same thing for me. Auto loans are going to get more expensive in the coming months. The average interest rate on a 5-year new car loan is at 6.18%, up from almost 4% last year. If the Federal Reserve keeps raising the interest rates, it will be even harder for people to get new cars. That's going to push more people to getting used cars for better deals. And I'm a big proponent of used cars anyway, just for the record. I don't even believe that you should have a new car unless you got over $1 million worth of assets. Just keeping it a buck. I think so many of y'all put yourself in the poorhouse because you spend so much money buying a brand new car that depreciates by 15% the minute you take it off the car lot. I know a lot of y'all hate me for that. Just keeping it a buck. This is not called the New Car Podcast. It's called the Generational Wealth Podcast. And when you study the habits of wealthy people, they don't put all of their money into a car. They have other assets that are appreciating in value. So if you're paying for a brand new car at a 6% interest rate on a freaking car loan, that's going to cost you almost $3,000 more in interest. If you got a 72-month car loan, and let's say you're paying tens of thousands of dollars, you're going to have to pay thousands of dollars more in interest, guys. Y'all don't see how this all adds up. See, when you study wealthy people like Warren Buffett, he thinks about the long game. How much is it going to cost me extra in interest? You know what? They're selling it for this price, but the interest means I'm going to have to pay $500 more, $1,000 more, $2,000 more. It adds up. The reason why they be getting so many of y'all is because it becomes a slow leak. And you wonder why, damn, why I ain't got no more money? I didn't buy all of these things at once. It's the slow leak that hits you. That's the reason why I never encourage having a car loan in the first place. I've been there before. but you want to get out of there as quickly as you can. If you have a credit card, pay off the balance every month. That's what I do. I'm an American Express card user. Every single month, card is paid off. Right now, I have the American Express preferred card, but I do not put more on that card than I can afford. I will take everyday purchases and I will use my credit card to give me cash back bonuses. Right now, you could get 3% cash back every time you go to the grocery store through an American Express credit card. And that's for the everyday card. If you are a blue card preferred, like how I have, you can get 6% cash back at the grocery store, 6% cash back at the gas station. Man, I be giving y'all so much game. I just be giving you the game. But you got to take action with it. It's not just about the knowledge. You got to apply it, y'all. All right. And if you're not good at using credit cards, don't get one at all. Watch the video that I did about why you shouldn't have credit cards. I made that video for people that need to get out of debt and don't have good financial discipline. Credit cards is a surefire way to sabotage your life if you don't have financial discipline. Now, back to where we were. So we've now talked about credit cards. We've talked about mortgages. And we've talked about cars. Credit cards, homes, and cars all going up. What are you going to do to protect yourself and your family? Because that's going to make it that much harder to put food on the table. This is the reason why I always stress to you guys, you got to make more money. You got to get a second stream of income. You've got to be a business owner so that you have unlimited income potential. I'm not telling you you're going to make unlimited income. I'm telling you that as a business owner, you have an unlimited potential. At your job, there's not unlimited potential. At your job, you have a fixed salary or a fixed hourly wage, and you'd be lucky to walk away with a 2 to 4% raise over the year. If you are a business owner, you could have a 10% raise this year, 20% or more. Business provides unlimited income potential. The fourth thing that we need to talk about is student loans. Interest rates increasing on student loans. Federal student loans, they are fixed. They have a fixed interest rates. So most borrowers are not going to be impacted instantly. Oh, but it will be a slow burn. Because if you're about to borrow money for college, then that means that the interest rates are going up. The federal loans will surely be adjusted based upon the Federal Reserve. We got to think about that, guys. So you got to know we're looking at federal student loans right now going up to 5% in interest. It was at 3% a year before. And a lot of y'all that had student loans, y'all are already familiar with interest being paused and all that stuff. A lot of that's coming to a stop. You saw what happened whenever Biden tried to push for those student loans being forgiven. A lot of that didn't even go through, guys. I warned y'all about that too. I warned y'all and I told y'all, don't put all your hope in the government bailout. If it happens, great. But just in case, make sure you stay on point, because if it never happens, nobody is coming to save you. Nobody cares that you put the money somewhere else. They're coming to collect. Right now, the average private student loan rate for the interest is anywhere between 4 to 15%. The same way that these other accounts are going up, so will the private student loan. Okay, so I just want y'all to be mindful about all this stuff. Again, right now for the federal student loan debt, you're profiting off of the 0% interest until the payment pause ends. but eventually that's supposed to stop sometime this year. But there's good news amidst all of this, guys. In spite of all of these prices and interest rates going up, this is an excellent time for savings. If you can afford to save money, you're going to be in a really good position to do that. Why? Because you can profit off of high interest rates. I've always told you guys on this channel, even though the news will market things as, oh man, everybody's suffering. In every economic downturn, somebody is profiting from it. Every time you hear stories in the news about, oh my God, people are losing it all, somebody is on the back end winning. And that's because they understand the market and they use the market to their own benefit. The people that don't watch content like this, they're going to suffer because they don't understand the only way that you can make the market work for you is if you know how to work against it. What do I mean? If the Fed is raising interest rates, you don't want to keep spending. You want to now capitalize on these interest rate increases by putting money in the bank. That's if you're trying to save. For all of you guys that need your emergency savings right now is the best time for you to save. Why? Because you can get almost 5% interest on a certificate of deposit at an online bank. I know a lot of y'all are not interested in getting like a 1-year CD. You could set up an online savings account and get a 4% interest. How do I know? Because I'm doing it. Right now, I have an online savings account that's giving me 4% interest. And that's giving me a lot of passive income per month. My money is working for me. But guys, these interest rates, it's not always going to be like this. The Federal Reserve, they're going to have the interest rates up for a while, but we don't know when they're going to start cutting back. A lot of people think that the interest rates are going to start getting cut back later this year, but we just got to wait and see. But the good news is you can capitalize on where the market is just by making sure that you have your money saved. I'm not telling you to save everything, but I am saying you should have savings. I always stress the importance, guys, of you having at least $1,000 in emergency savings just to cover you guys from minor emergencies. If you have your debts paid, you definitely need at least 3 to 6 months worth of savings in the bank. So that way, if anything happens, you're protected. Emergencies always happens, guys. None of us are fully immune to that. Life hits all of us. So you want to make sure that you have emergency savings so that way you don't have to go deeper into debt. Taking out a loan to cover your issues. The best way to capitalize on this market with high interest rates is through online accounts. And the reason why is because interest rates are higher from online banking accounts than they are at a brick and mortar. The reason is because brick and mortar banks, they have more expenses to cover because they own a building. Are y'all with me? Online banks are going to give you higher returns on average because they don't have as much overhead. So some of the best interest rates that you can find right now through a savings account, money market account, certificate of deposit are with online banks. The only thing that I want to caution you is Only put money into these accounts that you don't need to touch immediately. Like right now, I've got money in an online account, but that's money I don't need to touch. I have everyday money in other places. But when we talk about capitalizing on these savings, a lot of online accounts, they don't allow you to be able to transfer money instantly because you have to transfer the money within like 2 to 3 business days for it to go from your online account to your local bank for you to spend the money. You got to make sure that you can have this money and you don't need it at a moment's notice. For those of you that want to use online banks, I'm using Lending Club. I am not sponsored through Lending Club. Lending Club, I hope you all hear me. Lending Club, they give debit cards for your savings accounts. So if you needed to spend money as an emergency, you could just swipe your card. That's how you can access it quickly. But for a lot of other companies where you have online savings, there's a processing time for it to go from your online account to, wherever you bank at or wherever your credit union. So only put money into an online savings account that you can afford to set aside. If you need money that you can touch in 2 seconds, you still want to work with credit unions for the most part. Okay. So now let's talk about this. How can you capitalize on this market? You can take advantage of the high interest by getting a high interest yielding savings account. Whether you want to do a certificate of deposit means you deposit a certain amount of money. They give you a certificate saying, hey, you put in this money, you put in this deposit, we're going to promise you 5% interest. And then after the term of that policy, maybe you got it for 1 year. You promised that you would put your money into this fund for 1 year, not touch it. After that, they're going to give you 5% return on your money. You got to decide which one works best for you. For me, I honestly don't like using certificates of deposit. Right now, I have an online savings account through a money market investment. So that way, if I needed to touch the money within a week's time, I could do so and not incur any penalties. See, if y'all get a certificate of deposit, a CD, and you pull the money out early, you can be subject to penalties because of that. Okay. You could get taxed. And so you just got to think about what works best for you. So when the Fed keeps going up on interest, the yields will keep going up on interest. And you want to be on the high side of that, not the bad side. But guys, I want to show y'all something. A lot of y'all might think, oh, okay, well, man, I'm really able to get one over. No, you're not, because even with you getting a 4 to 5% return with interest, that still is lower than the inflation in the market, which means in the long term, you're still losing a bit of purchasing power. What you want to do is you want to be able to put your money towards things that are outpacing inflation. And believe it or not, one of the best accounts that allows you to do this right now, guys, is a Series I savings bond. Look it up. Right now, you can get a Series I savings bond at almost 7% interest. You know what? Let me just Google it. I ain't even going to show you all the receipts. Just Google it. Series I savings bond. You give your money and you're giving it to the government. You're giving it to the U.S. Treasury. Why? Because you know the government needs money. Look at how the debt keeps going up with this whole talk about the debt ceiling. The government needs money. And because the government is trying to cut back spending, what they're doing is they have these bonds where, you know how they say your word is your bond? It's a promise that if you put the money into the bond, you can walk away with 6.89% interest. Just look it up. Thank me later. Okay, guys? So this is showing you both sides of the coin. If you're a consumer, things are really expensive. If you are in debt, it's going to get bad. You want to make sure that you get out of debt as quickly as possible so that way when the interest rates rise, the cost of your debts don't compound over time. If you're out of debt and you want to capitalize on this moment, you can either A, put your money into a high interest yielding account with an online bank just to be able to give you a 4 or 5% return on your money. You could look that up. You can go to bankrate.com, guys, and it'll tell you all of the interest rates that are out there for online accounts. Also, if you want to put your money into a savings bond, I just told you one that's giving out almost 7% interest, guys. All right. Y'all are online. There's Google. You could look all of this up. I promise you, it's all right there, y'all. All right. So thank y'all so much for tapping in with me. I hope that y'all got a lot of value from this podcast. Can you leave me a comment and let me know your thoughts on today's show? Okay. If you didn't know anything about the Federal Reserve and what it does, now you know. The Federal Reserve, they print money. Their job is to be responsible over keeping the economy in the right place. And right now, there's a lot of work to be done. Okay. Before we shut it down, y'all, just in case any of y'all want to tap in with me, you can cam up right in this link below. And for those of y'all that have yet to smash that like button, please make sure to do so. All right. If you could please smash the like button, y'all. This is totally for free. It just takes 2 seconds. Just tap that thumbs up on your screen, and that'll tell YouTube to send this video out to a lot more people. We need financial literacy within the culture, and it's my calling to try to educate us so that we can level up, but I cannot do it without your help. So if you guys got a lot of value from this podcast, then please do me a favor, guys, and donate. All you got to do is tap that dollar icon directly below. Even if you watch this show after some of my live streams, you can still donate through either Cash App or Super Thanks. There's a button that says thanks under all of my YouTube videos. All you got to do is click thanks and donate there. For those of you that want to donate through Cash App, all you got to do is get on Cash App, $Gen Wealth Podcast, all one word. You can see it scrolling over right now across your screen. Okay. If you guys get a lot of value from my free content, I definitely want this year to be the time where you consider actually joining me behind the scenes. I want y'all to check out at least one of my programs. I've got your breakthrough year. I've got my free book, The How to Succeed Survival Guide. I've put together so much content over the years, guys, to help you guys maximize your money, maximize your time. I'm trying to help you become the best version of yourself. So if you're interested in becoming the best version of yourself over the next 12 months, I encourage you guys to join my elite 12-month coaching program, Your Breakthrough Year. I'm sure you guys have heard. People have worked with me privately, and they have gotten out of debt. They've gotten much better jobs. Recently, I helped somebody get a 6-figure position, and I'm really proud of her. And I want to show you guys how you can get your biggest goals accomplished 10 times faster. Because in this program, I'm showing you how the most successful people in the world manage their time, money, and their energy. High performance people play the game differently, guys. If you're just waking up and doing whatever, you're already behind the eight ball. You might not think it's a problem today, but I want you to see tomorrow. I want you to see what could happen in the future of America, where the middle class is completely done away, and you're either on the side of the have or the have nots. I know where I would want you to be, but you got to want that for yourself. And so, if you want to have a breakthrough year and you want to dominate the next 12 months of your life, I encourage you guys to click the link on the screen. Comments are popping. Make sure that you get in now. Breakthrough year, guys. 12 months. I'm going to be showing you how you can become the best version of yourself. I'm out of here, y'all. I love y'all. I appreciate all of your support. Please make sure that you share this content. If this is your first time watching this channel, please make sure that you subscribe. And don't forget to turn on that notification bell so you can receive an alert whenever I do another show. I try to do these shows Mondays, Wednesdays, and Fridays, y'all. I got a lot going as a business owner and a church leader. I try to do these shows whenever I can. Monday's show is going to be a little bit later on Monday evening. Lord willing, I'll be there, y'all. So make sure that y'all tap in with me. Maybe I'll try to get on there sometime around 8 o'clock. Sometime around 8 p.m. Central, I'll try to be on Monday, but just mark your calendars. Monday is going to be a little bit later, all right? Love y'all. I pray that y'all have an excellent weekend. Until next time,